If you turned on any financial news this week, you probably thought you were watching two completely different markets on two different days. Just yesterday, everything looked bright, indexes opened higher, optimism was everywhere, and it felt like the storm clouds had finally cleared. But only a few hours later, the whole picture flipped upside down. Stocks started sliding, and by the closing bell, the market had printed a brutal red candle. In a single day, investor sentiment pulled a full 360-degree turn, from euphoria straight into despair. This kind of roller coaster action makes people question everything. Should you trust that strong morning rally or the ugly close? Should you stay in the game or cut your losses and walk away? Well, here's the thing, this isn't just noise. The market is sending us a far deeper message, one that could shape every investor's financial future. Hey everyone, I'm Daryl Hart, your wealth strategist. Today we're going to cut through the fog of these conflicting signals and uncover what's really happening, a global migration of capital that's reshaping the entire investment landscape. To understand this neurotic market behavior, we've got to start with what triggered it, Trump's new tariff policy. So, what exactly does it mean? According to the current proposal, starting November 1st, 2025, Trump wants to impose a 100% tariff on Chinese goods and restrict exports of key software technologies. Now, let's pause here because this isn't just another trade spat over a few products. It's a direct shock to the foundation of global trade itself. At its core, it's the purest expression of America First economic isolationism, the idea of reshaping the entire supply chain to bring manufacturing back home. But here's where most people miss the point, the impact goes way beyond tariffs. Think of tariffs as an indirect tax on both corporate profits and consumer wallets. And this punch lands from three directions. First hit, corporate earnings expectations collapse. For multinational companies that rely heavily on global supply chains, this is a nightmare scenario. Think about names we all know, Apple, Tesla, Walmart. Their production costs would skyrocket overnight. Then they're left with two bad options. Either swallow those costs and watch profit margins shrink, or pass them on to consumers and kill demand. Either way, you end up with lower earnings, weaker guidance, and falling stock prices. Second hit, the ghost of inflation returns. This is the combo punch markets fear the most. Tariffs push domestic prices higher, rekindling the flames of inflation. And remember, right now the market is begging for the Fed to start cutting rates. But if inflation flares back up, the Fed's got no choice but to hold rate high for longer, maybe even raise them again. For growth stocks that live and die on cheap capital, like big tech, a high-rate environment is poison for valuations. Third hit, global growth slows down. Let's zoom out. There are no winners in a trade war. Tariff walls choke off trade volume and drag down global GDP growth. That hits U.S. multinationals hardest, the ones making money all over the world. Now here's where it all comes together. This avalanche of uncertainty is exactly what the market hates most. When uncertainty spikes, companies freeze capital spending, consumers tighten their wallets, and investors dump risky assets. That's what's really driving these violent swings we've been seeing. But let's stop and ask the key question, where did all that money go when it left stocks? Because money doesn't disappear, it migrates. And right now, it's migrating fast into the so-called safe havens, the US dollar and Treasuries. As equities swung wildly, the dollar index strengthened and Treasury prices climbed. That's the classic panic playbook, global capital rushing for the most liquid, risk-free assets on Earth. But here's the problem, that route may be safe, but it barely pays. In an environment where inflation could come roaring back, holding too much cash or low-yield treasuries risks quietly losing purchasing power. Still, not every part of the stock market was a casualty. Some segments, especially tech stocks, managed to stay afloat, buoyed by the ongoing AI hype. Take AMD, for example. Their massive partnership with OpenAI gave the stock a strong run recently, lifting chip stocks and the Nasdaq along with it. Or look at MP Materials, the rare earth miner. The stock exploded 21% recently, after being crushed for years. From June to now, in just 4.5 months, it's up 500%. Yeah, you heard that right, 500%. But beyond stocks, there's another survivor class, alternative assets, especially crypto. And that, my friends, may be the most important part of this whole story. While the stock market was whipsawing, crypto prices held remarkably steady. That contrast tells you something deeper, something structural. It shows the rise of what I call the maturity of alternative assets. Unlike Trump's tariff plan, which screams centralization and government control, crypto's whole foundation is decentralization and resistance to censorship. So when traditional finance becomes hostage to political risk, some investors don't see crypto as speculation anymore. They see it as a macro hedge. That's part of why selling pressure has eased, fewer short-term gamblers, more long-term allocators. And here's a stat that proves it. According to CoinShares by Q3 2025, institutional investors held 22% of all circulating crypto. These players care less about hype and more about balance. Their steady hand have dampened volatility. So this current calm isn't an accident. It's a signal that crypto is maturing into a legitimate component of global macro portfolios. And here's the irony. While markets fear tariffs could stoke inflation, Bitcoin, nicknamed digital gold, is suddenly back in the spotlight as a hedge against fiat depreciation and macro chaos. Sure, it's more volatile than gold, but for a new generation of investors and even some institutions, it's becoming the hedge of choice. Now, let's not forget another key point. Not all the capital leaving tech stocks went into treasuries. Some of it, the more risk-hungry money, went searching for a new battlefield. A place with high volatility, high potential returns, and a big, bold narrative. Guess what fits that description perfectly? The 24/7, globally traded crypto market. It's the perfect new playground for that capital. Let's be real. October's crazy market reversal? We've seen this movie before. Just a few months ago, the exact same pattern played out. Veteran traders took one look and laughed. Oh, it's happening again. They even gave the setup a spicy nickname, the taco strategy. It stands for threat and compromise opportunity, meaning when a government issues an extreme threat, markets panic, and then suddenly reverse when compromise arrives at the last minute. So what's the game? You wait for the panic to peak, then scoop up high-quality assets that got unfairly crushed, betting that fear will fade and prices will snap back. Let's rewind to April 2025. Back then, the Trump administration floated the idea of invoking the International Emergency Economic Powers Act, IEPA, to sanction Chinese companies allegedly using Mexico as a backdoor export route into the U.S. The moment that rumor hit the wires, markets went nuts. During the week of April 15th, the S&P 500 plunged about 5%, the Dow Jones fell over 1,500 points, and the VIX Volatility Index spiked above 30. Meanwhile, the US dollar surged to near multi-year highs, and Treasury yields swung violently. Pure panic. But here's where the smart money started thinking differently. Sharp traders noticed that while Trump's rhetoric was fiery, US officials were quietly engaging in back-channel talks with China. They realized this wasn't an all-out economic war. It was a pressure tactic before negotiations. That's when the taco strategy was born. In simple terms, when everyone else dumps risk assets in fear, you step in and buy those linked to trade policy, but with strong fundamentals. We're talking about select tech stocks, thematic plays, even crypto. And guess what happened? By late April, Treasury Secretary Janet Yellen softened her tone, saying, "Sanctions are the last resort. The door for dialogue remains open." Boom, the market flipped. We saw a V-shaped recovery across major indexes. Those who followed the taco playbook, buying when panic peaked, walked away with serious alpha. What started as a joke among a few traders suddenly became a recognized macro trading framework. April versus October, two acts of the same drama. Now fast forward to October. The similarities are uncanny. Step 1, an extreme threat. In April, it was IEEPA sanctions. In October, it's the 100% tariff plan. Same formula, different packaging. At its core, both aim to stir the pot, amplify fear, crank up bargaining power, and load the negotiation table with leverage. Step 2, the good cop/bad cop act. In April, Yellen played the dove while Trump turned up the heat. In October, the softer tone came from Vice President Vance. It's classic theater, one hard, one soft, pressure and relief in perfect rhythm. Step 3, the market's reflex. The initial reaction to threats, flight to safety. The reaction to soft signals, risk appetite snapping back. That's the heartbeat of the taco strategy. betting that this Pavlovian chain of fear and relief will repeat. But here's the twist: why this time feels different. Despite the similarities, there are two crucial differences between April and October, and they matter a lot for anyone trying to ride this wave. Difference 1: policy reversibility. Back in April, the proposed sanctions were legally messy and slow to implement. In contrast, the October tariffs fall under the president's executive authority, which means they can happen fast, like real-world fast. So the November 1st tariff cliff feels way more real. That also means the taco strategy now carries less margin for error. Difference 2: market memory. After April, traders learned the pattern. They've been desensitized to Trump's tariff theatrics. So this time, the sell-off might be less violent and the rebound faster but shorter-lived. The window to play taco is shrinking. So what should investors do? How do you navigate your portfolio through this chaos and still grow your wealth? First, learn to recognize the taco signal cycle. Policy rhetoric comes in two phases: the pressure phase and the relief phase. When panic from the pressure phase drives irrational selling, that's your moment to stay calm and hunt for quality assets that got hit too hard. Second, focus on key exposure assets. This round, pay attention to Chinese exporters with high U.S. dependency, U.S. tech companies deeply tied to China's supply chain, and crypto, the global liquidity barometer. These are the ones that fall hardest in fear and bounce fastest when calm returns. Third, set a clear risk boundary. Remember, taco is a game of probabilities. Draw your red line. If by the end of October there's still no sign of real negotiations, or if Trump doubles down with harsher rhetoric, you exit. Because no matter how good the setup looks, taco can fail. And discipline beats ego every single time. For long-term investors, there's something even more important than short-term trades. It's the shift in mindset from trading to allocation. The taco waves, those violent swings between fear and relief, actually give us perfect chances to rebalance our portfolios. It's during the chaos that you get to make the smartest moves. So what's the play? Start tilting your exposure toward sectors less vulnerable to geopolitics. Industries driven more by domestic demand and real economic fundamentals. That's how you make your portfolio more resilient when the global stage turns stormy. And remember this: Vance's speech isn't the end of the story. It's just the beginning of the next chapter in a much larger game. The threat and negotiate pattern has officially become the soundtrack of today's markets. From April to October, the taco strategy has proven one thing: markets are learning to coexist with this new style of negotiation governance. So as investors, our job isn't to predict every policy twist. It's to decode the rhythm, stay one step ahead of the crowd, and exploit the pricing mistakes caused by emotional overreactions. In other words, before the next taco moment arrives, don't waste time guessing what Trump's next card will be. Spend that time preparing your playbook. Let's be real for a second. In the coming quarters, the real drivers of the market won't be quarterly earnings reports. They'll be Washington's trade policy and the Federal Reserve's rate decisions. That means you've got to spend more time studying macro logic, not just chasing chart patterns or daily price action. Understand the why behind the headlines. And here's a rule to live by. When volatility spikes, don't chase green candles or panic sell red ones. Seeing Bitcoin soar and going all in? Dangerous. Seeing stocks plunge and dumping everything? Even worse. Stick to your allocation plan. Set your take profit and stop loss levels before emotions kick in. Discipline is what separates investors from speculators. If tariffs actually go into effect and escalate, volatility will persist. But if the threats turn out to be all bark and no bite, the market could stage a revenge rally, a sharp rebound fueled by relief. Ultimately, the next few weeks will hinge on how U.S.-China interactions evolve and how those trade policies take shape. Meanwhile, the Fed's monetary stance will keep playing a massive role in determining market direction. At the end of the day, markets are mirrors. They reflect both our hopes and our fears. They're constantly evolving, finding balance in the chaos. When policy creates turbulence, capital doesn't disappear, it migrates. Just like what we're seeing now, the rise of crypto resilience isn't just about tech. It's about a paradigm shift in investing itself. True wealth doesn't come from predicting every storm. It comes from building a ship strong enough to survive any sea. That's our job as investors. To read the signals, navigate through the fog, and make decisions grounded in logic, not emotion. As your wealth strategist, I'm here to help you do exactly that. To understand the patterns behind the chaos and to turn uncertainty into opportunity. The tariff storm may have just begun, but once you understand how capital migrates, you can ride the waves instead of being swallowed by them. If today's breakdown gave you new insight into what's really driving this market, don't forget to subscribe and hit that notification bell. Every week, I'll bring you deeper dives into the latest macro events, actionable wealth strategies, and practical steps for navigating risk and allocation. Together, we'll build not just a portfolio, but a fortress of resilient wealth.